The stock market is currently closed for the weekend. The last trading session ended on Thursday, July 2nd, 2026, due to the upcoming holiday weekend, and Tesla stock closed at exactly $393.45 per share, marking a significant intraday drop of 5.97% on heavy volume. Now, if you were watching the financial news headlines this week, that number should completely confuse you. The broader market expected a massive rally because Tesla just announced that it blew past all Wall Street expectations for its second quarter vehicle deliveries, posting an all-time record of over 480,000 vehicles. Normally, a massive beat like that sends the stock straight to the moon. Yet the reality on the ground is that institutional investors used this good news as a liquidity window to dump shares, pulling the stock down nearly 6% in a single day. This creates a fascinating disconnect between what retail traders see on their favorite investing sites and what the big money is actually doing behind the scenes. The common belief right now is that the electric vehicle giant is finally regaining its footing after facing 2 straight years of annual sales declines. People look at the massive 25% year-over-year jump in deliveries and think the worst is over for Elon Musk's company. But if you take a contrarian view and look deeper into the numbers, the reality is far more complex and dangerous for short-term holders. The surge in deliveries wasn't driven by a massive, sustainable wave of consumer demand in its core American market. It was heavily propped up by temporary government incentives in Europe, aggressive fleet discounting, and an artificial drawdown of older inventory that had been sitting in parking lots since the first quarter. When you realize that production actually trailed deliveries by 28,000 units because Tesla actively paused lines, the narrative shifts from one of roaring growth to one of careful supply management and margin compression. When you look at current online investing trends, retail traders using platforms like the Robinhood app or looking for simple investment help often chase the top-line headlines without looking at the underlying cost structures. Over the last week, the trading volume on Tesla stock surged to over 73 million shares, showing massive institutional rotation. If you look at options order flows on advanced platforms like Interactive Brokers Trading, large block trades were heavily skewed toward put options just as the delivery data dropped. This tells us that while the public was celebrating a return to form, professional wealth managers at places like Fidelity Wealth Management were hedging their positions or outright selling into the strength. The stock has been trapped in a volatile cycle all through 2026, down roughly 13% since the start of the year, and sitting 27% below its historical peak of nearly $500. The daily swings we are witnessing right now reflect a deeper anxiety about the upcoming second quarter earnings call scheduled for July 22, 2026. Savvy investors who do their own research via self-investing tools know that deliveries are only one side of the ledger. To get those high delivery numbers in places like Germany and France, the company had to cut leasing costs and offer massive financing discounts. This means that when the final financial reports drop on the Fidelity trading platform later this month, we are highly likely to see another hit to the company's automotive gross margins, which have already been under intense pressure. Professional traders are anticipating this margin squeeze, which is exactly why the stock tanked despite the record sales announcement. Let's look at the institutional positioning for a moment because that is where the real story hides. If you manage a large fund or run a balanced portfolio through services like Schwab Intelligent Portfolios, you have to weigh the asset's current valuation against its actual cash generation. Right now, Tesla is trading at an incredibly high price-to-earnings ratio, far exceeding traditional car manufacturers and even most high-growth tech stocks. The stock market is treating this company not as an automaker, but as an artificial intelligence and robotics powerhouse. This high valuation requires the company to spend astronomical amounts of capital. In fact, capital expenditure for 2026 is projected to hit over $25 billion, which is nearly triple what they spent just a year ago. That money is being pulled directly from vehicle profits to fund massive computing clusters, autonomous driving software, and humanoid robot lines. This brings us to a major structural shift that occurred recently that many casual observers completely missed. In May, the company quietly made the decision to halt production of its high-end luxury models, the S and X, at its Fremont factory. The plan is to completely repurpose those production lines to build the Optimus humanoid robots. While this sounds incredibly advanced and futuristic, it means that in the immediate future, the company's automotive revenue relies almost entirely on just two aging platforms, the Model 3 and the Model Y, along with a slow rollout of the low-volume Cybertruck. If you look at individual brokerage accounts across the country, many investors don't realize that the product lineup is shrinking rather than expanding. Comment below how many shares of Tesla stock you currently hold and whether you think giving up on traditional luxury models to focus entirely on robotics is the right move for their cash flow right now. To truly understand how we got to this point, we need to look at what this business model actually looks like today versus 5 years ago. For a long time, the company was a pure-play electric vehicle stock, enjoying a mere monopoly in the Western markets. Money poured into the sector, and anyone looking to invest online in clean energy default bought this asset. Today, the competitive landscape has fundamentally changed. Chinese rivals like BYD have scaled up massively, offering cheaper vehicles with advanced tech, forcing Western companies to engage in price wars. To counter this, the Texas-based company has been forced to shift its core identity. They're trying to transition into an autonomous fleet provider, aiming towards a network of cyber-driving cybercabs. But until those vehicles are approved by global regulators and operating at scale, the bills are still being paid by selling consumer cars. There is, however, one bright spot in the recent data that traditional investing sites often undervalue, and that is the energy storage business. In the same second quarter report, the company revealed that it deployed 13.5 gigawatt-hours of energy storage products, marking a massive 40% increase year over year. This division builds massive utility-scale batteries that help stabilize electrical grids, and its growth has been much more stable and profitable than the car side of the business lately. For long-term investors looking at Fidelity ETFs or building a diversified retirement account through Fidelity IRAs, this energy segment provides a necessary buffer against the wild swings of the global automotive market. It shows that the company is successfully building a secondary revenue stream that could eventually challenge its primary business in terms of pure profitability. When you look at the macroeconomic environment, the pressure on all growth stocks is immense right now. High interest rates have made traditional auto loans incredibly expensive for the average consumer, which explains why North American sales have remained sluggish despite the big numbers coming out of Europe. If you're using basic Robinhood stock trading or managing an active account on SoFi Invest, you have to understand that macro pressures affect high valuation stocks first and hardest. A high interest rate environment means that $1 of profit earned 10 years from now in a robotics division is worth significantly less today than $1 earned right now by a traditional cash-generating company. That is the fundamental mathematical reason why the stock struggles to sustain its upward momentum whenever it approaches key resistance levels. Looking at the technical chart, the recent drop to $393.45 puts the stock back into a critical consolidation zone. Every time the price dips towards the high 300s, we see a wave of retail buying coming from casual investors using a mobile app to pick up fractional shares. They see the lower price as a discount, remembering when the stock was trading closer to its highs. But the institutional order flow tells us that large asset managers are using these retail-led rallies to trim their exposure. They're reallocating that capital into other mega-cap tech names like Apple stock or Nvidia stock, where the immediate revenue growth from commercial products is much more visible and certain. This constant tug-of-war between retail optimism and institutional realism is exactly what creates the intense volatility we see every week. So where does the expectation versus reality dynamic leave us as we head into the second half of the year? The expectation created by the company is that their massive investments in computing infrastructure will soon lead to an autonomous driving breakthrough that will make every existing vehicle on the road an appreciating asset. The reality that the financial data shows is a company dealing with intense global competition, shrinking margins on its core products, and a massive capital expenditure bill that will drain cash reserves for quarters to come. It's a classic high-stakes bet where the downside risk is a painful revaluation to a traditional industrial stock multiples, while the upside relies on achieving a technological feat that has never been done at scale. For anyone navigating the modern markets, whether you're using automated tools like a SoFi robo-advisor, picking individual names via interactive brokers setups, or looking for broad sector exposure through Fidelity mutual funds, this company remains the